COMEX silver market, COMEX silver market, the paper settled liquidity element, along with producer financing initiatives leaching over into the Chinese physical exchanges, silver has now largely escaped the LBMA stranglehold. These same actors are having difficulty in containing silver, as is now evidenced by the very large exchange for physical premiums to short cover, levels we actually haven't seen since the COVID shortages. The LBMA has lost the paper to physical battle and are racing to short cover. Okay, you're going to see some intraday moves, but this is short-term stuff. And while spot silver is not Basel III compliant, it is a deliverable foreign exchange money cross against the dollar, etc. It's quite revealing. Let's take a quick look at the charts, as it makes it much easier to explain. Just for reference, I'm recording this after the PM fix on Wednesday. But let's just step through. Look no further than last week's efforts, really to synthetically sell the Asian-facing, physically determined AM fix into each day's synthetically diluted PM fix. So AM fix, PM fix, AM fix, PM fix, AM fix, PM fix, AM fix, PM fix. It was getting tiresome. Then on Friday, that broke. Then on Monday, it actually backfired. And it also backfired again yesterday. Now, it looked pretty good today, but then, of course, now we've got the EU deal being telegraphed as a tariff deal being announced. So we have the usual wait until it's fully cleared to pull the bids and create some downdraft. This is all short-term stuff, because into each day's synthetically diluted sell-off, their central banks are underpinning the next in a series of higher stair steps, which is already in place. And really, so basically what they've been trying to do is walk gold below the 50-day moving average, which is rising, basically because you're going to see a lot of momentums go short there. So essentially that's all that's going on.
After the Shanghai Futures Exchange's debut on March 1st, 2024, BRICS nations accelerated siphoning of unallocated Western gold into their vaults. The traditional London-based LBMA CME pricing regime is losing strength. Russia is fast-tracking a competing mechanism. The St. Petersburg International Mercantile Exchange, SPIMEX, is slated to begin physical gold trading by year's end, creating a national benchmark based on supply and demand, not paper markets.
And here we are creating another higher stair step, probably here, but already in place. We had this already in place in our last episode. Now, obviously, we're headed into another end-of-month mark-to-market derivative event, which is really what this is all about. And there are so many physical buyers who are literally going to sit and stealthily wait to take what's on offer into the end of the month. So after a little bit of healthy consolidation, i.e. kicking out some of the specs that jumped on board, what we're seeing is this is only going to serve to underpin the already established, but also the next higher physically determined stair step, after which we're looking for gold to commence the next leg of a large short squeeze. Weighed up against the bigger picture, following the PBOC's strategic launch of the Shanghai Futures Exchange on the 1st of March 2024, the process of draining unallocated Western gold into BRICS nations' vaults has significantly stepped up. So short-term official attempts to cap gold against the dollar by way of monthly wash and rinse cycles, and this is a monthly chart. So we see here. What it reveals is 16 months of Fed-borrowed Bank of International Settlements gold leases being bought back at higher and higher and higher and higher prices. And we've only had 1 month, and that was in December, where actually they managed to buy it back lower. And that was after a massive attempt to rinse out speculators, which was immediately bought by China. So we just move forward to where we are now, and one by one, these settlements have been higher and higher and higher, and even last month, despite every effort, they failed to get it any lower.
Gold lease rates, effectively the cost to borrow bullion, have spiked sharply, signaling unusually tight physical supply. Rates are now sitting well above average, having risen to between 3 to 5% recently. In India, jeweler Titan warns of rising lease costs, currently around 1.5 to 2%, due to redirected supply toward lucrative U.S. futures markets. This strain reflects growing physical demand that paper-based markets are struggling to meet.
What this is illustrating is the slow demise of the LBMA CME's price capping influence. The resulting impossible to ignore series of higher physically supported stair steps provides clear evidence that sufficient CME LBMA paper market liquidity has been alchemized, meaning turned into physical gold, by physically settled exchanges, which are now taking control away from the LBMA CME ringmasters so as to benchmark a real globally determined supply-demand price, namely the price the owner of a physical bar is actually willing to accept an offer for it. In gold, with very few offers to even lend metal now, lease costs have also expanded. Short-term lease rates for gold are currently 9.4%, indicating tight supply. Now this is a silver chart. I'm going to actually ask you to remember this spike higher where silver finally broke out of the LBMA's control, and the 92-cent premiums being charged for the shorts to actually cover. And essentially that proves that these asymmetrically imbalanced trades, this is commercials having to buy back their short trades well in excess of $4,000 per contract, higher than they wanted to. So just keep that in mind for when we look at silver. So in summary, the LBMA are losing control of this counterintuitively based 50-year price suppression game, which has allowed them to cash settle gold alongside every other fiat diluted asset.
China's cross-border interbank payment system, CIPS, has expanded dramatically, now connecting nearly 4,900 banking institutions across roughly 186 countries. With the rollout of CIPS 2.0, real-time cross-border settlements in about 7.2 seconds became feasible, slashing costs almost entirely compared to SWIFT's multi-day delays. This development is a fast-moving salvo in the monetary realignment underway, particularly among BRI-aligned economies.
And they're losing this control because in aggregate, the BRICS nations have now accrued sufficient physical market liquidity to actually benchmark this self-arbitraging, fungible global sanction and tariff-proof gold price for T+0 settlement. We're talking instantaneous settlement. So in sync with the NDB rollout, China's cross-border payment system, the CIPS, already interconnects with 4,900 banking institutions, and it's growing by several every day. Now, the CIPS settlement platform actually overtook SWIFT transactions in April. I thought it was May, but it was April. So tokenizing these BRICS collaborations into stable coins backed by real assets, along with a race to secure as much gold as possible to back the value of each nation's foreign exchange currency, provides BRICS nations and their counterparties with a very liquid 7-second settlement process. Now, following Trump's 50-day Russian and BRICS counterparty tariff sanction threats that followed 2 weeks, I think it was last week or the week before, when we saw freshly weaponized EU-Russia sanctions, what we have is credible information. The already beta-tested 40% gold-backed decentralized sanction and tariff-proofed blockchain rails are about to formally launch. The clues are actually all there. Following China opening up and opening vaulting and physical metal facilities into a series of western-facing gold vaults and settlement hubs where it can be moved across the floor and delivered T+0. There's a lot more of these beginning to follow. Now, these are already the same hubs that we referred to earlier. We've got Singapore, Shanghai, Hong Kong, Saudi, Russia, Brazil, Africa, Southeast Asia, and there's more to come. These are all vaulting hubs, Shanghai facing, vaulting, international facing, vaulting hubs where gold can be priced centrally in the BRICS areas and can then be delivered T+0, as I say, by literally moving it. And it's fungible, so therefore if a transaction happens in Singapore and it's happening in Brazil, because it's fungible, then literally you just move it across the floor here and you move it across the floor here. So it's so simple. It's unbelievable. As part of the initiative to price gold outside of local London, Russia is launching gold trading on the St. Petersburg exchange, which is the SPIMEX, and more initiatives to benchmark gold and silver within the BRICS sphere are rolling out monthly. We're going to see a hell of a lot more. So really, to sum up, we're witnessing the demise of the Western-run paper-driven gold suppression game, which is why every single bullion bank, every central bank, sovereign and institutional buyers are swapping, they're depreciating, debasing fiat currencies to load up on physical gold and silver at prices they perceive to be hundreds of dollars below where the as yet undefined supply-demand price ultimately is going to settle.
Gold trading and custodial frameworks are converging to favor physical control. The SPIMEX-Goznak partnership enables trading of both standard and weighted bullion with transparent pricing and custodial integrity. Meanwhile, BRICS nations are broadening precious metals reserves and ramping up institutional accumulation, part of a strategic pivot away from Western-dominated gold pools.
COMEX silver market, the COMEX silver market, the paper-settled liquidity element, along with producer financing initiatives leaching over into the Chinese physical exchanges, silver has now largely escaped the LBMA stranglehold. These same actors are having difficulty in containing silver, as is now evidenced by the very large exchange for physical premiums to short cover, levels we actually haven't seen since the COVID shortages. The LBMA has lost the paper to physical battle and are racing to short cover. Okay, you're going to see some intraday moves, but this is short-term stuff. And while spot silver is not Basel III compliant, it is a deliverable foreign exchange money cross against the dollar, etc. And as with silver supply getting priced outside of the LBMA's control, the local London global silver FX fix is that benchmarks the global physical supply demand settlement price is going to have to rise to meet this balance, or it's just going to be drained, which is exactly what we're seeing now. The silver fix benchmarks a direct producer to end user price, so any discrepancies will be arbitraged. Liquidity providers report continued accumulation of underpriced LBMA CME silver is stepping up. So to put the BRICS-driven silver LBMA short squeeze into perspective, we really noted two things. The current front contract silver contract, the contract versus weighed up against the spot price, the physical spot price. That EFP, that exchange for physical, that connection, in other words, the ability to short cover, has significantly expanded into price rises, and then it rapidly contracts into bid-pulled dips.
Taken together, these trends reveal a paradigm shift. The traditional paper-driven suppression of precious metals is eroding. Sovereign and institutional buyers are flocking to physical gold and silver at prices well below the deeper fundamental support levels suggested by real demand. Tight lease conditions, limited lending availability, and rising premiums, especially in silver, signal that a substantive short squeeze may already be underway. For investors, the pertinent question becomes, how much of your currency exposure are you positioning against undervalued, physically settled bullion today?
So what's this telling us? It's because we initially evidenced a 92-cent COMEX premium. That's, ouch, $4,600 per contract. You had to pay that premium to be able to cover shorts into the 11th of July BRICS-driven breakout. However, as I record this, the cost to short cover asymmetrically imbalanced shorts is still elevated at around 40 cents or $2,000 per contract. I mean, evidencing this paper to physical imbalance is still unresolved. So short-term silver lease rates are also at 6.5%, also attesting to this tight supply. And looking at the option structure, which is obviously we always look at what's going on at the end of each month, and Monday is options expiry. And of course, these option structures are, after given the price rises, and they were put in place a long time ago, between 6 and 12 months ago, they're offside. Now, silver is not, this contract is not in delivery, but footprints are evidencing that this asymmetric imbalance short skewed EFP price, because it's commanding such very large premiums, we're seeing dips being used as opportunities to short cover. And this should keep dips shallow and continue to drive very large short squeeze into the 50s, where we expect very large sideline BRICS demand to pick up. Best estimate is $80 before equilibrium is found. So look, thank you so much for your questions. The only one I have for you is how much physical gold and silver do you have now? And how much of your depreciating fiat dollars, pounds, euros, yens, Swiss francs, etc. are you investing into grossly underpriced physical gold and silver?